So I've been getting a lot of questions on which market is better, right? You got the real estate market and you have the stock market. I have some extra cash. I want to, get the best bang for my buck. How do I allocate this cash, and what asset classes do I go in? Real estate or the stock market? Well, it's kind of like Batman versus Robin. Who's better, right? Jordan versus whoever, right? Who's better? Brady versus Manning. Who's better? Uh, you're always going to go with your guy, right? So whoever you like, or whoever if you're biased to one or the other, if you have skin in the game, you're always going to pump or push for whatever person or thing that you're rooting for. So as a disclaimer, I am a stock guy, right? I'm a portfolio manager, so I'm going to have more bias towards the stock market, right? But I'm going to let the numbers do the talking today, okay? We're gonna try to take me being biased out of it, or you being biased out of it, whether you like real estate or the stock market, and just go with the pure numbers, okay? So what we're gonna do is we're gonna break down the appreciation from a historical standpoint for both homes and the stock market, and then we'll put real numbers to that, and then come up with a decision that'll hopefully sway you into a right decision. Okay, so first we're going to start with with the home market, and I will say this: I tell my clients all the time that 2009 was a blessing in disguise, right? Because before the recession of 2009, no one believed that home prices would ever decrease, right? They always increased, or they always appreciated, and never, appreciated. They never depreciated. So when the crash came, not only did it take the stock market, but it also took the housing market, which hasn't fully recovered to this day. The stock market has, but the real estate market hasn't. But so it's good to, not good, but it helps people understand the risk that are associated with investing in the home market. Everyone always knows about the risk about the stock market, but now you kind of get to see some of the risk that is investing in real estate. I'm gonna give you a big risk right now. Okay, so we're gonna start with home appreciation, and I'm gonna use the Case-Shiller index, which was created in 1987 by two highly respected economists. You can look it up for yourself, research it, but they go back as far as 1987. And on a historical standpoint, or on an average, homes appreciate about 3.4% a year. Now, keep that in perspective, because you're going to have your big major markets like San Francisco, New York, and even DC that are going to be outliers, right? Some homes may appreciate at a much higher rate, just like you may find a stock that shoots up 300%, but that doesn't speak for the rest of the market. That's just an outlier. So we're going to go with our average, which is 3.4% a year, right, of home appreciation. Okay. Now, before I start to dive into the expenses that are associated with real estate, I'm going to give you the biggest expense that is not only associated with real estate, but is also associated with the stock market. It's actually associated with any type of investment you have, and that's this scary guy here called inflation. And I did some research on inflation. I went back as far as 1914 and did what has been published for 2016. And on an average yearly basis, inflation appreciates, or on average, from an annual standpoint, you have 3.3% inflation, right? 3.3% inflation. Okay. So again, 3.4% home appreciation on a historical basis, and now you have 3.3% inflation on a historical basis. And again, inflation measures your dollar output, right? What can your dollar buy that it couldn't buy a couple years ago, or how far does your dollar stretch? In other words, right? So, for an example, 15 years ago, $1 may have been able to buy a can of soda and a candy bar. And today that $1 may not even buy a can of soda. So that's inflation. It eats at your money. So folks that have their monies just in banks that make no interest, or hide your money in mattresses or in your shoebox because you don't trust the system, well, technically you're losing money, because that inflation is going to eat at your money every year at a 3.3% rate. Okay. Now, just as a caveat, for the last couple of years, inflation has been around 2.5% a year. But again, from an historical standpoint, going back to 1914, we're going to use 3.3% a year. Okay? So that's the so home, just to recap, home appreciation happens about 3.4% a year. You have the 3.3% a year of inflation that you have to deal with, and we haven't talked about the expenses that go into your house. Okay, and we're not talking flipping homes, right? We're talking people that buy homes and stay in their homes for 30 years, and we'll get to that in a second. Now let's move on to the stock market. Okay, and I'm going to use the S&P 500 index, which was created back in 1928. And from a historical standpoint, the market, or the stock market, returns about 10% a year. Okay, and if you break down that 10%, you're looking at about 6.5% or 6.7% of the stocks themselves appreciating, and the other half is the dividend payouts, right? So companies like Microsoft or Walmart that pay dividends, okay? So 10% a year, going back to 1928, okay? Now, the stock market does have their expenses as well. So trading fees, when you buy and sell your stock, those are trading fees. Now, if you're not day trading, then these fees are pretty nominal. In other words, they're not that expensive if you're not day trading, right? If you're buying great companies and you're holding those companies, then these trading fees are nominal, okay? So there's a big difference in home expenses versus stock market expenses when you're dealing with the taxes that you have to pay on an annual basis. You're dealing with insurance that you're paying. Interest, of course, is the rate that the bank is willing to lend you the money to purchase your home. And don't forget about those pesky condo dues and homeowner association fees, which you have to pay for. Even when your house is paid off, that bill still remains. And we haven't even mentioned the maintenance and the upkeep costs that bring, that you have to pay to keep your house up, right? Roof goes bad, plumbing, whatever, cutting your yard. Those are expenses that also go into your home that eat at your overall gain, okay? That a lot of people don't consider. You don't have those type of expenses when you're dealing with the stock market. Okay, any questions so far? Good. All right. Next, we're going to put numbers to this, right? So we have our percentages. We have our 3.4% annual home appreciation. We know that inflation is costing us around 3.3%. And we know that the stock market is returning about 10%. So the difference already between the two, home appreciation is 3.4%, inflation is 3.3%. So if you minus the inflation, right, from your home appreciation, you're looking at 0.1%, okay? And you do the same on this side. 3.3% inflation, okay? You're still left with a big delta between your home appreciation and your stock market appreciation. You're left with 6.7% from the stock market side if you back out your inflation. So now we're going to put some hard numbers to this. Oh, and just as a quick caveat, home prices typically rise with wage growth, right? So think about it. If the economy or the people, us the people that make up America or make up the economy, if our wages are not growing or not keeping pace with home appreciation, then there's going to be millions of people that can't afford homes. Now that is the case in some areas, but from an overall perspective, in aggregate, wages usually keep up with home appreciation, and wage growth is about 3.3% historically. Okay, so that's just a quick caveat. All right, so now we're gonna put some numbers to this thing, and so we're gonna make some assumptions. We're assuming that you're gonna purchase a home that costs $200,000. Your interest rate was about 4.5%, which is roughly the rate right about now, maybe a little bit lower. And again, we're using 3.4% home appreciation for a 30-year period, okay? So we're taking that $200,000, which we paid for the house, for 30 years at a 3.4% rate. It's going to get you roughly $545,000 and some change. Okay, sounds great, right? It took you 30 years to get there, though. Okay, plus we haven't factored in those home expenses and the maintenance and all that we spoke about earlier. But what we are going to factor in is our enemy, not our friend, our enemy, inflation, right? Which is 3.3%. We already spoke about that earlier. And if we multiply 3.3% times 30 years, we get 529,000, roughly $530,000 worth of inflation that's sucking our investment. You always have to consider inflation, always. That's how you get your real return, okay? If we subtract out that $530,000 worth of inflation, we're going to be left with roughly $16,000 at the end of the day. That doesn't sound like a pretty good investment when you start talking 30 years, okay? So now we're going to go down to the stock market. And again, we said that the market returns about 10% a year, okay? Again, we're making some assumptions. We're assuming that for your initial deposit into the stock market to buy stocks cost you $5,000. And then you're also going to put in $1,500 a month for 30 years, which is roughly about what your mortgage will cost you on a $200,000 home, right? Okay, for 30 years, once you add those numbers, the $5,000 plus the $1,500 that you're going to invest on a monthly basis, which should match what you would pay on your mortgage, again, for 30 years at 10%, you're going to bring home over $3 million, okay? Again, we're going to back out our inflation, right, so we can get our real return. And again, inflation's about $530,000 for 30 years at 3.3%. You're going to subtract that out, and you're going to be left with $2.5 million, okay? That's a huge delta between the $15,000 that you would have been left with your home investment versus your stock market investment. Now, I know I threw some numbers at you, so it may not make sense. So go back and look at the tape again and kind of walk through what I did. There are a couple of websites out there, a couple of apps that you can plug these numbers in to kind of back your way into what I did. But again, just making some quick assumptions. These are big deltas between the two investment vehicles. So again, I'm going to let the numbers speak for me. Again, I do have a bias. You know, I'm a portfolio manager, so I would always, sway my clients into investing in the market because I know what compound interest does. This isn't fairy dust. This isn't magic. This is real arithmetic. And when you have the power of compound interest working for you, these are some of the numbers that you can make, okay? So $2.5 million, again with the numbers. We've already backed out inflation. Look at the big delta between if you were to just stay in the home at 30 years, getting 3.4% return on that home. Listen, you don't want to play around with your financial freedom. This is serious business. This is why I'm doing this video because, again, there's a lot of there's just a lot of bad information on just relying on real estate alone. You really need to be invested in the market. Hopefully this cleared up some different issues out there that folks have. And it's a major risk if you're just relying on your home to get you through your retirement years. You need to be invested here in the market. Thanks.